It's certainly a problem and something my next guest has actually been concerned about for some time. I want to bring in DFW housing and macro econ analyst Amy Nixon. So, Amy, on February 1st, the 30-year mortgage dipped to under 7%. It felt like, okay, coast is clear, we're coming back. Here we are now marching back toward 8%. What does it mean for housing?
You know, Charles, there's actually sort of a theory circulating in the industry now that these higher rates are actually exacerbating shelter inflation. And it sounds a little wacky at first, but if you think about it, it's causing, like you said, there's that 3-point spread. It's causing existing homeowners to not sell. So supply is being crunched. Buying demand is being crunched because people who would perhaps be buying at a 3 or 4% rate are not buying at a 7% rate. What does that mean? Shelter demand is always there. So shelter demand has moved from buying to renting, and we now have a cohort of 6-figure earning renters who would be buyers maybe at lower rates, but they're now coming to the rental market, and that's actually helping keep rent inflation sticky. So it's an interesting theory, and I think that that actually might be part of what's going on and why we keep seeing this sticky component to shelter in the CPI inflation numbers.
You know, that is interesting because those numbers were supposed to come down months ago. According to the experts, right, a year ago, give it 3 months, give it 4 months. The government data is always lagging. You're right. It's been a year, and the needle hasn't budged, but you have to worry about how long that's sustainable. And do we want a country of just renters? You know, I just spoke with Nancy Lazar. She used the word bifurcation like 3 or 4 times. I'm going to borrow it now because nobody's building homes for under $300,000. But these $1 million plus homes, they're flying off the shelves. Is that just, again, a tale of 2 different worlds that we live in right now?
It is a tale of 2 different markets. We have record asset inflation right now in this country, and what that means is the people who have money have a lot of money. They've got still stocks, cryptos, everything is near all-time highs, even with the recent pullback. So we're seeing, I think New York just said a record 60-something% of homes sold in Q1 were sold all cash. And essentially this market is moving, but it's moving for people who have money. And that leaves out the young people and the first-time home buyers who have income but not money. So they rely on borrowing.
Real quick, you always point this out that some of these places have overbuilt. Austin, you talk about a lot. I just saw some stuff with Florida. I mean, these asking prices are coming down huge. So is the answer that if you do want to get a house, you may have to move to a state that you didn't think about living in before?
I think for young people, you need to start thinking about locating to places where the median home is still somewhat in the relative range of the median income and where we are still building. Where there is new construction, they're still buying down rates. There is product that's being priced lower. They're starting to build smaller, more, quote, affordable homes. So I think that's probably going to be the best option for a lot of young people right now, unfortunately. All
right. Well, it's not just residential, Amy. In fact, meanwhile, commercial real estate, that continues to grapple with its own set of issues. Let's go back to Lydia Hugh.
Yeah, Charles, there was a headline that we caught that caught our attention today. I want to show it to you. It says commercial real estate foreclosures soar to levels not seen in nearly a decade. And let me show you exactly what we're talking about, because most recently we're clocking in at 625 commercial foreclosures. Charles, that's a level that we haven't seen since roughly 2015. But there are some signs, maybe, that the worst could be over. We can talk about that. Check this out from the Wall Street Journal today. Blackstone's beleaguered real estate fund stems the exodus. The needle moved a little bit because it was able to fulfill all investor redemption requests in February and March for the first time since 2022. But we also have to look at fundraising because that hasn't returned to its previous robust levels. Let's check it out here. We do see a tiny step up here most recently, but we're not coming anywhere close to where we were before. And that speaks to the trepidation that we're seeing in the commercial real estate market. Charles, back to you.
Lydia, thank you very much. I want to go back to DFW housing macro econ analyst Amy Nixon. All right, Amy, so let's talk about these mounting foreclosures. We kind of knew they were coming, but as they mount, they become worrisome. What are your thoughts?
You know, they're still low on a relative basis to history, but yes, they are mounting. like I said, this higher rate environment is causing problems in credit markets. It's causing problems in industries that are reliant on credit. And so we're seeing, while we have a strong service economy and there's still a lot of inflation in several areas, we're seeing contraction in the construction and building industry. So I think this is it feels like right now it's a race against the wire to how soon are we going to cut rates, and is it going to be soon enough to save a lot of these people that have this floating rate debt that need to refinance it sooner than later. And if we cut rates just in the nick of time, maybe we can come out of this okay. If not, I think we're going to see more turmoil ahead in that industry.
That turmoil, I guess it would also include these regional banks?
Yes.
You know, I saw I saw where a 185 square foot building in Chicago was sold for $2.5 million. In 2013, it was bought for $22 million. And we're talking about a 90% haircut. I don't know anything about commercial real estate, but golly, I would love to own that building on the screen right now for $2.5 million. So I guess there are opportunities out there, right?
Yeah, I mean, there have been opportunities in commercial for the last 2 years. And again, I think once again, it's kind of everybody's sort of holding their breath, waiting to see what happens with the interest rates. And the longer that rates are high, the higher the odds that we're going to see cracks in this sector and see possible problems with regional banks and with bank failures. But again, I think at the end of the day, the Fed will protect the banks. They showed us that in 2008. They showed us that in 2021 when they stepped in sort of with this BTFP program. Right. They will not let things just fall. They're not going to stand by and just let things fall apart. So while it could have severe impacts on the economy and we could go into a recession, I don't think it's going to be a situation where it's just like a complete collapse of everything.
Right. And by the way,
time will tell.
The demand for that program is still going through the roof. 30 seconds. I'm going to circle back to residential. These home builders, Pulte posted a strong number. They're in the catbird seat. I mean, if no one's selling an existing home, they have pricing power. It feels like they've got all the leverage. So you think these home builders continue to see pretty good stock gains?
I'm not sure, Charles. You know why? Because in March, we actually posted dismal construction numbers. Housing starts dropped, I think, 15% month over month. And that, again, is a reflection of the costly credit. I think builders are starting to get a little bit concerned in this higher for longer rate market about how much product they're going to be able to move. So that, again, is crunching supply and sort of circling back to that original thesis I said that perhaps we're at a point now where these higher rates are actually just exacerbating shelter inflation, which is kind of a catch-22.
It is. Great stuff, Amy. Thank you very much. Talk to you again real soon.
Thank you.